Commercial real estate leaders gathered in San Diego for the annual Mortgage Bankers Association's Finance Conference, where I sat down with key players to talk debt, equity, and risk across all sectors, starting with JP Morgan's head of commercial real estate.
As we start 2026, it's nice to see a continuation of the trends that we were happy to be a part of during 2025. Increased equity to the space, increased debt capital, just general liquidity all around. Coupling that with strong fundamentals across all asset classes, we saw the transaction volume start to come back. And our pipelines as we start 26 confirm that while there are certainly geopolitical and macro risks, deal making in commercial real estate is on the rise.
Okay, you said that there are good fundamentals, but when you look at office, it's still not there yet. And multifamily is starting, we're seeing the fundamentals in multifamily weaken.
Yeah. So I think what's your frame of reference, right? Relative to 21, 22, we've certainly returned to normal range of interest rates, not lows and low cap rates that we had for a couple of years. Across asset class fundamentals, real estate has always been a supply discussion, right? And so certainly in office, pointed out heavily during the COVID time, the trend that we had built too much office in the 80s, and we had too many buildings. It was there. But as we round 6 years post-COVID, and we see the first quarter and the fourth quarter of positive absorption in the space, you can see that supply issue starting to normalize.
So do you have a favorite sector and a least favorite sector right now?
I would say we would expect all sectors to be active in 26. We obviously do the most in multifamily. It's the largest asset class and we're there for our clients. We expect that to be active, particularly as you look at the debt maturing in 26, close to $1 trillion of mortgages, a heavy contingent of which is multifamily. And if you think about that one step further, a lot of that is that 5-year reset point from the 2021 debt vintage.
But you feel you're going to be able to refi those in this higher interest rate environment?
I think, again, it's that span of higher interest rates. Rates are in a reasonable range. If you think about base rates right now, 6 months SOFR, 5-year Treasury, high threes. Layer on top of that the spreads that are being offered across all capital sources to the mortgage market. Those spreads are quite compelling relative to historical levels, which means in most areas that you're borrowing, you're in the 5 to 6% range. Again, if you were assuming 21 rates would hold forever, you're 200 basis points higher than your assumption, but I don't think that's what most of our clients were doing.
So what would you stay away from? What are you most concerned about?
I'm a lender, right? Well, scratch that. We're a bank supporting our clients. Our number one product is loans. All of my bankers are trained to pencils down when someone asks for high leverage, full cash flow, and basically a free option to walk away. That's not the type of product that we support. We know that to do well in this industry, to be wildly successful over the long term, it's always a disciplined approach to your leverage.
It seems that private capital is really taking over the arm in commercial real estate now, that they're more avid than they've ever been before. What does that say to you?
They were a helpful partner over the last few years, right? If you look at the $5 trillion mortgage market, banks froze to an extent after quantitative tightening began, and many went insular, either on managing their own liquidity positions or managing distress in their portfolio. Private capital certainly stepped in there with additional lending sources to keep a portion of the liquidity to the market. I think as we go through 2026, that normalizes. The banks are back, which as the bank that stayed active the last few years, we're happy to see. And I think with that, the returns that some of that fundraising was around in the private space will be harder to find. And I would expect those equity allocations to maybe move to a different area versus debt to find those appropriate returns.
Justin Wheeler, CEO of Berkadia, which did $52 billion in commercial real estate transactions last year, a lot of that in multifamily, and you have a new survey out on the multifamily sector and its sentiment within it. Tell me about what you're seeing, because we are seeing fundamentals weaken in multifamily.
Yeah, I'd say a couple of things. One, there's a real concern with operating performance, labor costs, what's happening with rents, especially in certain areas where the market's oversupplied with units. So there certainly is kind of a dampener on the excitement about it, as maybe in the short term as markets kind of sort themselves out. But I would say that, last year we had one of the questions we asked, are you finding it easier to underwrite deals, or are you finding it very difficult? And last year, 48% of the respondents, and these are 250 apartment owners, said very difficult. This year, that was 1%. And so
but rents are falling.
Rents are falling, things are happening, but
how does that pencil?
Well, for one thing, debt capital is so available now. And not only do you have, luckily in the multifamily space, Fannie and Freddie, who provide a bedrock and some HUD as well, but you also now have private equity through private credit vehicles who are supplying a lot of capital. And so when you have kind of aggressive debt that is willing to, maybe stretch on proceeds or do a little bit different structure, people are finding ways to get good deals done. And there's a little bit of stress in the market. And so there are transactions that, for various reasons have to get done, and maybe the equity's got to take a haircut or something like that are being forced through. But we're not quite yet at the stage where we're seeing flow business, like just kind of the business plan, buy it, fix it, work on the rents, do those sorts of things, and then 4 years later you sell it. That story or that business model isn't quite flowing like it did, pre 2023.
Now the expectation though was that demand would continue to rise because it's just unaffordable still to buy a home. So you have people renting for longer, staying in place, which means you can't raise the rent on them quite as much as if you're signing a new lease. So you're seeing that mix. Are you confident that you're going to start to see rents turn up again, or is the jobs picture not what you expected?
I'd say there's two things. There's some markets that are just plain oversupplied. I mean, you could look at places like West Phoenix. There's just areas where they just, in this last cycle, they just built too many apartments. Record supply, yeah. I mean, I think in West Phoenix, they said that in an 18-month period, they delivered 94% more than the existing stock in an 18-month period. It just takes a while for those markets to absorb, for households to form, for that to get rented out, and that causes some stress. So I would say there certainly is from that level. And then you talk about the demand side. This is going to be a very interesting spring rental season. There's a lot of conversations about the job market, especially for new college graduates. Do they get jobs and, get an apartment and kind of live that life, or do they really struggle to find employment? Do they maybe, instead of 3 people getting 3 apartments, do 3 people get 1 apartment so that they can share the rent and kind of keep that up? We're going to find a lot out in this spring on the demand side. And then, as I said, on the supply side, we just have to see the different markets work themselves out. There are actually some markets that are undersupplied, but most of the markets, especially the southeast markets where the action was really, really hot, most of those have an oversupply problem that's probably going to last for another 6 to 12 months in some cases.
And the administration is working on affordability. They've raised the caps for lending from Fannie and Freddie to multifamily, which should be a boon to your business. But what happens if they privatize Fannie and Freddie?
I don't think that the business model of Fannie and Freddie, which is providing that stability and liquidity and affordability for the U.S. housing market, both on the single family and multifamily side, I don't think that mission changes. So the actual structure of the entities is probably less important than the fact that the government remains the regulator.
I heard from the banks that, the banks are back in commercial real estate. What are you seeing in the state of lending right now?
There's a lot of debt capital right now. But again, it kind of gets down to you got to be very specific. One place where there is a lack of capital right now is construction. And that was really traditionally, banks probably did 80–85% of all construction financing. They've really pulled back. Banks now, given how their capital treatment is, they'd rather do back leverage. They'd rather, back lever a fund or something like that versus making whole loans. And so they're kind of a little bit, I'd say, not out of the picture, but they've pulled back a little bit.
I think things are certainly getting better and they're starting to rev their engines, but it's not taking off quite yet, right? Lending's up, volumes are up, but they're still well below previous peaks. My view is we should start investing, and we have been investing in planting those seeds now. Because if you can make investments in this year, last year, next year, I think these are going to be great vintage years. And so whether or not the returns really pop in 26 or 27 or 28, I think you start making the investments now.
And Nuveen is across many different sectors of commercial real estate. So what are some of the under the radar plays that we might want to know?
Yeah, no, that's a great question. I mean, everybody sort of talks about sheds and beds, multifamily and industrial. We have a few interesting ones that we're leaning into pretty heavily. One is convenience-based retail.
So retail's not dead.
Retail's not dead, particularly on what I would call like convenience-based, grocery-anchored, well-located retail assets. So we were one of the largest buyers of retail last year. We've raised an additional $1.4 billion. We probably have $2.5 billion of dry powder for commercial, sort of convenience-based retail. And so we're going to go heavy into that. Cap rates are a little bit higher. People haven't built in a long time, so there's very little supply. Occupancies at the right centers that are well located are very high, and we can push rents. So we feel like it's a good risk-adjusted return.
And what do you think of how data centers are being financed right now? Because there's a lot of controversy over this, whether the hyperscalers are financing their own, maybe half of it, and then you have private capital going into data centers. From your view, is it as risky as some other, CEOs like yourself think it is?
Well, I do think there's some risk probably on the exit. There's not a lot of risk in the demand right now because there seems to be just tons of demand for it. But upon the exit, I think that's really where you'll have to see if it plays out, right? Because there's such large checks. And that's why lots of times you're seeing syndications. And so people are taking smaller bite sizes.
So what's your strategy in data centers?
Yeah, so it's really largely through our infrastructure group, which pairs with our real estate group. And they've made investments into data companies that are now developing. And so on the data center front, we're really doing on the development side. So kind of build new data centers and then sell.
And what about this argument that we're oversupplied already with data centers?
Yeah, I mean, if you look at the data, there really is quite a bit of demand, and we think that the next 5 years there's not an oversupply situation.
And what about, again, the argument that AI is meant to make everything more efficient, including AI, and that way you wouldn't need quite as many data centers as we think we do because AI is not going to need as much space anymore.
Right, I think that is a longer term risk. But I think over the next 5 to 10 years, we feel pretty good about it if you look at going forward. But there are going to be some risks that you just don't know, right? There's going to be evolution pretty quickly. And so that's why we're looking at sort of shorter term builds and then sells.
What do you see as the biggest friction in getting the kind of financing that you want?
So we've had great success in financing in 2025 and into 26. So even though spreads have been a little volatile, rates are higher, we look at the debt business as something that's been a real benefit to our overall business models. We've borrowed at rates that are better probably than what we underwrote, and we've been able to get higher proceeds than generally what we've underwrote too. So the debt business has been very successful for us over the last 18 months.
So I've gone to 2 big conventions in the last month, Diana. First was the CREFC conference in Miami, which is where all the lenders come together to talk about the upcoming year and what they're looking at. And it was almost euphoric. Everyone had capital. They're looking to put capital into the market, which is a great thing. Then I went to the National Multifamily Housing Council conference in Las Vegas 2 weeks ago, and all of the apartment operators were sitting there kind of with their heads in their hands going, we were waiting for rent growth and we haven't gotten rent growth. The operating fundamentals of our assets aren't as good as we thought they would be at this point. What's going on? And I think that attitude between the two, where there's a lot of capital out there that wants to both lend on the debt side and invest on the equity side, is a great thing for the market and very healthy. And yet at the same time, the operating fundamentals are quite weak. And I think one of the issues there is that everyone saw that the supply curve was going to come down and that the demand curve was going to keep going up. And what we've seen is the demand curve has started to bend and has started to fall off at the end of 2025. And a lot of apartment owners are waiting for that demand curve to sort of turn around and head back up.
And when's that going to happen?
It's a great question because there are lots of questions about the jobs report. There are lots of questions about whether this growth in GDP is actually corresponding to growth in employment. And that's why the jobs report that's coming out this week is going to be so important to people saying, is this a jobless recovery, or are we actually seeing employment growth along with growth in the stock market, growth in GDP?
So in your mind, though, should we be concerned about growing delinquencies in commercial mortgage-backed securities in the apartment space? Because we are seeing growth in CMBS and multifamily in delinquencies.
Yeah, as you well know, both Fannie and Freddie have exceedingly strong portfolios with de minimis losses in those portfolios. So Fannie and Freddie and CMBS are a little bit different, and Fannie and Freddie are almost 50% of the market. So one of the things you have to sort of think about there in the CMBS market is that those loans are on properties that, for whatever reason, the borrower's desire as it relates to being a floating rate instrument or the leverage level they wanted didn't go to the agencies, right? And so you have, to some degree, a higher risk profile in CMBS portfolios than you will get in Fannie and Freddie's portfolios. But you're correct, the delinquency rate has gone up. Obviously nothing close to office. Office just hit a I don't know whether it's an all-time high, but it's almost as high as it's been since the great financial crisis of 12.3% office delinquencies in CMBS pool. So multi is not office in any way, but there is some questions as it relates to overall health of the assets that have those loans on them.
And so when you look at the overall economy, should commercial real estate be doing better overall, not just multifamily, but we look at the economy improving and we think that commercial real estate should be, you know, going gangbusters, but it's not in the deal making. Why is that?
Well, we have to be very clear about what asset class we're talking about, right? So office, every time that you and I have spoken in the past, everyone says commercial real estate and they go office. Well, there are a lot of other asset classes in there. Office has been struggling, but we are seeing people going back to the offices. We're seeing some of the AI companies start to take serious space out in San Francisco. And there's a very significant bid on San Francisco office today where 18 months ago, there was no bid. Nobody wanted it, nobody wanted to touch it. So that's a big change in the market, and that will continue to progress. Industrial has been sort of the darling for the last 20 years. It's still doing very well because of the growth of Amazon and online distribution and things of that nature. If you think about hospitality, you and I are in a big hotel here, which I'm assuming, because it's a big convention hotel, had real problems during the pandemic. Today, this place is operating, I'm assuming, extremely well. And so then you get to multi. And multi is always that single family versus multifamily. I mean, that's the competitive set, right? If people are jumping into single family, that brings down occupancy and brings down rents on multifamily. When people can't afford single family, people stay in multifamily. And right now what you're seeing is single family is still too unaffordable, too expensive for people to go and jump into a single family home. So they're staying in multifamily. The problem is you've still got that supply issue to get through before owners can start to move rents. The other thing from a policy standpoint, Diana, is the administration wants to see the cost of living, wants to see inflation go down. This flat to negative rent on the multifamily side is making renting more affordable to the American consumer. And so from a policy standpoint, that's not a bad thing. It's not great for our customers who are borrowing from Walker & Dunlop and putting debt on their properties, but it's a very good thing to the overall economy.
So in your mind, is this going to be a busy year for CRE?
This will be a very busy year. A busy year. I don't have any clients who are sitting there saying this is going to be my greatest year as it relates to selling assets and making a lot of money. But I think this is a repositioning year. I think people have been through the great tightening. People were holding on. They weren't going to refinance an asset. They weren't going to sell an asset at a value that they didn't want to sell it at. I think today people have been forced to either recycle capital back to their investors or just take an asset and say, we need to move on. That allows someone else to come in at a new basis and sort of, if you will, establish a new life for that asset, and they can do what they're going to do over the next 5-10 years.